Good afternoon, everyone, and welcome to our webinar on the Federal Budget 2023-24. We're delighted that so many of you could join us today. I'd like to begin by acknowledging the traditional custodians of country where we each meet and recognise their continuing connection to land, waters and culture. I'm in the land of the Wurundjeri people of the Kulin Nation, and I pay my respects to their elders past, present and emerging. Thank you for joining us. My name is Anthony Bradiker, and I'm a partner in the tax team here at Hall & Wilcox. I'm joined today by a panel of business and industry experts, including Jarek Kovcha from the Westpac Business Bank. From Hall & Wilcox, we have Todd Bromwich, Senior Associate in the tax team, Meg Lee, Partner and Leader of the Environment, Social and Governance Group, Katrina Ray, Leader of our Social and Affordable Housing Group, and Alison Choi Flanagan, Partner and Leader of the Health and Community Group. Today we'll cover key details in the budget handed down last night by Treasurer Jim Chalmers. Jarek will start us off by taking a look at the budget from an economic perspective, following which we'll run through the key tax changes that were announced. After that, we'll hear from our industry experts on what the budget means for their sector. First, some housekeeping. If you have any questions you would like to have asked, please type them into the chat function at the bottom of your screen. You can also upvote questions you would like to hear more about. So to start, I'm going to hand over to Jarek, who will provide his thoughts on the federal budget. Thanks, Jarek.
Thank you very much, Anthony, and welcome everyone today to the presentation. So I'll kick off with a few minutes really covering the big picture themes from this budget, and also talking about the main economic impacts, but also the main fiscal impacts from this budget as well. So Camelia, if you could please move forward to the next slide. So I want to talk through the main key takeaways from this budget, and then dig into some of the details in the next slides as well. So of course, from a fiscal perspective, the really key piece of information is that we do have the first surplus for 15 years, with 2022-23 predicted to be a surplus. And that really comes off the back of a much stronger economy and also much higher commodity prices, which have of course flowed through into much stronger personal income tax collections and company tax collections as well for the government. On top of that, there's been an improvement on the payment side as well in 22-23, which also contributes to the government going into a small surplus. But this is temporary. Looking further forward, the government is expected to go back into a deficit with a $13.9 billion deficit in 23-24, and then at its peak, the deficit is expected to be $36.6 billion in 2025-26. If we look further onwards, the budget is expected to go back into a broad balance as we go into a net balance position by the end of the medium term in 23-24. And it's important to note that this longer term outlook is a really large improvement from the ongoing and very persistent 2% structural budget deficit that existed in the October budget. And that really reflects both lower interest rate payments, given that bond yield assumptions are lower, and also much lower costs from the NDIS following the government implementing the National Cabinet Agreement to cap growth in that area. On top of that, there are also some other assumption changes around commodity prices, and population growth is also expected to be quite a lot stronger, which all contributes to an improvement in the budget bottom line over the medium term. But with regards to the economy is still expected to slow quite sharply following 22-23, with an increase in unemployment and a decrease in GDP growth. And I think it's important to really point out here that dwelling investment growth is actually expected to be negative for 3 years, for 3 full financial years. And that's really likely to put further pressure on the housing market, which is of course already extremely tight, and particularly in the context of record net overseas migration predictions over those same years as well. One of the key differences from this budget compared to, for example, the RBA, is that the government expects inflation to get back into the RBA's 2 to 3% band a little bit earlier than the RBA does itself. So there's slightly lower inflation forecasts of 3.25% in 23-24 and 2.75% in 24-25, and that's about 25 basis points lower than the RBA's estimates. Of course, from a spending perspective, the cost of living package really was the centerpiece this budget. And on top of that, the government has spent a little bit over $20 billion in the net terms on spending decisions over the forwards. And this has been largely front-loaded with about 12 billion in 23-24, or about 0.5% of GDP. And that does compare to spending decisions which were actually lower than $10 billion in the October budget. So the key question from a macroeconomic perspective is this budget likely to be inflationary? And of course, we know that the economy is really pushing up against mini capacity constraints at the moment, which really does explain why, well, partly explains why inflation has been so strong. And this increased spending is likely to place further upward pressure on inflation as well. But it remains to be seen whether it will ultimately lead to further cash rate hikes from the RBA or not. But it definitely does place some additional pressure in a net sense. But it's also important to note that the pass-through is not going to be direct or necessarily simple, because some of the measures that the government's put through actually lower measured CPI, given that they reflect government subsidies for things such as energy. So the measure of CPI will actually be a bit lower, but of course that frees up spending for other people to perhaps spend in other areas of the economy, which does place upward pressure on inflation there. So Camilla, if you could move to the next slide, please. So this shows some of the key changes from an economic forecast perspective. Now you would notice that most of the changes from the October budget were relatively minor, but the things I just want to bring to your attention are a relatively large increase in nominal GDP in the first few years, and that does reflect changes to commodity price assumptions from the Treasury, and also changes to their expectations of how long it will take for commodities to trend back to long run averages. And on top of that, the population growth numbers have also been revised higher quite a bit, with net overseas migration expected to hit record levels in this financial year and remain around those levels for the next few years. So Camilla, if you could move forward, please. From a budget bottom line perspective, as I mentioned, the budget's expected to be in surplus of 4.2 billion, or around 0.2% of GDP in 22-23. But that is temporary, and further beyond that, the budget is expected to go back into deficit. And this deficit grows to around 1% of GDP by the end of the forward estimates in 26-27. But then, as I mentioned earlier, it does shrink further on and ends at about 0.2% of GDP by the end of the medium term. And if we do have an upgrade for the budget bottom line, that does also lead to lower borrowing requirements for the government. So we've seen net debt be revised down as well relative to the previous budget. So it's expected to peak earlier and at a lower level relative to GDP. So the peak is now expected to be 24.1% of GDP in 26-27. And then it's expected to fall to just a little bit under 20% at 19.9% of GDP by the end of the medium term. And that compares to the October 22 budget, when net debt was expected to be around 31.9% by the end of the medium term. So it's quite a significant improvement in net debt of around 12 percentage points by the end of the medium term. And if we could move forward to the next slide, please. Now, the government has banked a fair chunk of the improvement that it's seen to the budget bottom line due to stronger tax revenues, in particular personal income tax revenues and company tax revenues. And you can see that the total improvement from the economy is actually almost $150 billion to the budget bottom line. And that reflects almost $70 billion for higher personal income taxes due to the stronger labour market and stronger economy, and also a little bit over 50 billion on the company tax side, which largely reflects stronger commodity prices. But the government hasn't banked all of it. it has nevertheless increased spending by a little bit over $20 billion over the forward estimates. And that's been a little bit front loaded into the near term. So we've got a total increase of almost $43 billion in net spending, being partially offset by an increase of $22 billion in additional revenue. And that reflects some tax changes that the government has put through, which of course will be talked about a little bit later. But if we look to 23-24, we can see that spending has increased by $13.8 billion in that year in net terms. So once you take account of both the payment side and the revenue side. And that does reflect about 0.5% of GDP in that one particular year. And again, as I mentioned earlier, of course, the economy is running up against pretty significant capacity constraints at the moment. So that's really going to be the key question. Is 0.5% of GDP of stimulus into the economy significant enough to add to inflationary pressures? And we do think it will likely add to those pressures, but it remains to be seen whether it will lead to the RBA raising rates further. But one point I do want to make as well, which the government didn't really make in its budget, but of course the government is looking to support some of the most needy people in society, people on government support payments, on unemployment payments, and so forth. So while that may perhaps lead to further interest rate hikes from the RBA if it adds to inflationary pressures, it does shift a bit of the burden for addressing inflation, because of course people who typically have home loans are typically a bit wealthier and a bit more higher income than people who are on government support payments such as job seeker. So it does shift the burden a little bit perhaps for tackling inflation by helping to support the most needy in the economy. So thank you very much. I mean, that's a very quick run through of the key macroeconomic impacts for the budget. And of course, I'm happy to take some questions later on in the Q&A session.
Terrific. Thanks, Yarrick. It seems that Treasurer Chalmers has been blessed with some quite good economic fortune that's seen his first budget return a surplus, but there's definitely some headwinds on the horizon. Look, turning now to the tax announcements in the budget. Can you push that along to the next slide, please? Look, I think as a general observation, from a purely tax perspective, the key threads from last night's budget were threefold. I think first, there has been a pullback on certain measures announced in prior budgets to rein in spending and boost tax revenue. Secondly, there's been definitely an increased focus on spending on tax compliance for the ATO and the like, and Todd will tell us a bit more about that. And finally, like the last few budgets, there is unfortunately no genuine tax reform here, or any substantive government policy guidance. In looking at the detail of the measures from a corporate tax perspective first, and we're going to run through these pretty quickly, but there are a few announcements regarding the Petroleum Resource Rent Tax, PRRT. The main announcement last night was that the government is proposing a cap on the use of deductions. Now, the change is going to limit the proportion of PRRT assessable income that can be offset by deductions to 90%. And the intention is to bring forward PRRT revenue from LNG projects so that the offshore LNG industry pays more tax and they pay it sooner. On the build-to-rent front, we had a bit of an update for eligible build-to-rent construction. Now, this is basically large-scale apartments and housing projects. Starting from 9 May 2023, last night, the announcements will do two things. First one is it's going to increase the building allowance capital works deduction from 2.5% to 4%. And secondly, it's going to reduce the withholding tax payable on fund payments made to foreign investors of managed investment trusts, MITs, those of which are engaged in BTR activities. They're going to reduce that withholding rate from 30% to 15%. And then finally, the government's also going to extend the Clean Building MIT withholding tax concession. And that concession provides a 10% withholding on payments to non-residents to data centres and warehouses that meet the upgraded 6-star energy efficiency standard. The Treasurer also announced a new minimum tax for multinational groups. The announcement implements measures flagged by the OECD and G20 that were designed to ensure large multinationals pay an effective minimum level of tax on the income arising in every jurisdiction where they operate. Now, there's two measures that are being introduced. Firstly, there is a 15% global minimum tax. And what that represents and means is it'll basically enable Australia to apply a top-up tax on an Australian resident company of a multinational group, where the whole group's income is taxed below 15% overseas. So typically where the foreign group, multinational group is invested and has itself based in offshore havens where there is a low rate of tax. So Australia is going to assert some taxing rights there to ensure that the Australian part of the structure pays 15% global tax. Secondly, a 15% domestic minimum tax is also going to be introduced. It's going to give Australia the first claim on top-up tax for any low-taxed domestic, i.e. Australian income, in the rare circumstances, admittedly, where the effective Australian tax rate of a resident company of a multinational group falls below 15%. Now, we have to see the full details, but these measures and these types of taxes are not uncommon in a global context. So we'll look forward to seeing the detail of that legislation when it gets released. Look, importantly, there is a significant cutoff. The measures only apply to the very largest of groups, large multinationals with annual global revenue of euro 750 million. That's about Aussie 1.2 billion or more. So it's only going to hit the highest income groups of income earners from a corporate perspective. Now, finally, in an announcement reflecting FBT, fringe benefits tax, the government's going to sunset and effectively end the eligibility of plug-in hybrid electric cars from the FBT exemption that currently is in place for all eligible electric cars. So it's going to cut off the availability for a subset of these electric vehicles. That change is going to apply from 1 July 2025. Actually, sorry, that should be 1 April 2025, the FBT year. Can we get next slide, please? Now, there was very little in the budget for small business. Of note were the following measures that are coming up on the screen there, introduced to support small-scale capital investment. Now, first of all, small businesses with an aggregated annual turnover of less than $50 million will be able to deduct an additional 20% of the cost of eligible depreciable assets that support electrification and more efficient use of energy. Now, that includes upgrades to existing assets, and examples will include upgrades to more efficient electrical goods and those that support electrification, such as heat pumps, cooling systems, and thermal energy storage. There are some exclusions. For example, it doesn't cover the purchase of electric vehicles. The bonus deduction here is going to be capped at $20,000 for each small business. So we're not talking sheep stations, but every little bit counts, I guess, when you're in small business. And it requires that eligible assets are going to be have to be installed and ready for use between 1 July 2023 and 30 June 24. Now, I guess while the policy behind this can be applauded, I guess query the extent to which small businesses are going to have excess cash available to make these purchases to qualify for the bonus deduction. Secondly, the small businesses with an annual aggregate turnover of under $10 million, so a smaller subset of small business taxpayers, are going to be able to immediately deduct, so it's an instant asset write-off, for the full cost of eligible assets costing less than $20,000 that are first used or installed ready for use this coming 1 July until June 24. The threshold applies on a per asset basis, allowing small businesses to write off multiple assets, and there doesn't appear to be any apparent cap on the write-off. Finally, I just want to mention about the fact that there were next to no significant tax changes or announcements in the innovation and tech space, unlike in the last couple of budgets. What was notable was the announcement regarding the abandonment of the patent box measures that were announced in earlier budgets that were designed to make Australia a hub for invention and encourage the development of patents. So that's all I've got to say on the corporate and the business side of things. I'm now going to hand over to Todd to round out the other key tax measures announced in the budget, particularly those for individuals.
Thanks, Anthony. I'll start off with the superannuation measures. So first up, in a different order to the slides, the government's confirmed an earlier announcement to implement payday super for employees. Now, at the moment, you'll all be aware that employers have to pay superannuation guarantee entitlements on a quarterly basis. They're going to adjust that from 1 July 2026 so that the superannuation guarantee has to be paid on the same day as the underlying salary and wage entitlements. Now, this should result in better retirement outcomes for me and my fellow wage slaves, as super will be credited to the accounts earlier, to the funds, and it'll start generating income earlier. But there are concerns that on the other side of the books, that'll put more increasing cash flow and administrative burden pressures on employers that may be hard to manage. Luckily, there's a bit of a delayed start date, so employers, super funds, payroll service providers will have until 1 July 2026 to adjust their systems and their cash flow practices to account for this. Although unless the ATO expands its clearinghouse service to larger taxpayers, we do expect that this will put a greater burden on the financial systems that are currently in place, including private clearinghouses. One thing in particular we're concerned about, particularly for smaller employers, is the potential for increased instances of non-compliance arising from this more regular payment obligations. So if, for example, if an employer pays the superannuation, they process the payment on their side of the books on the required payment date. At the moment, if that payment doesn't make it into the super fund by that same date, it makes it in 1 day late, technically they have not met their superannuation guarantee obligations. It triggers an SGC liability. It's something that's not well understood and a lot of employers fall foul of, and it's something that we could see a substantial increase in instances of under this new payday super system. So we'll be interested to see how the government adjusts the legislation, and they may potentially look to overhaul the existing system to account for this. We've also seen that the budget confirmed some earlier proposed changes to the non-arm's length income or NALI rules, which were largely reflect proposed changes that were set out in a January 2023 Treasury consultation paper. So the ATO's current position is that in some circumstances, non-arm's length income can have a sufficient nexus to all of the income, ordinary and statutory, of a super fund. And so you could end up with a situation where you have a fairly minor or minute amount of non-arm's length income for a year that could taint all of the income for the fund, which results in that income being taxed at the highest marginal rate. Now, that review coming out of the ATO caused a massive fuss in the industry. Treasury did some consultation on it and some proposed changes. They proposed an upper limit to amounts taxable as non-arm's length income of 5 times the amount of a general expense breach. That continued to cause some fuss in the industry. The budget seems to have wound that back a bit and instead proposed an upper limit of 2 times a general expense breach, which would also exclude contributions. The budget also confirmed that large APRA-regulated funds would be exempt from the non-arm's length income provisions. And finally, the government confirmed earlier announcements, as we would have seen for quite some time now, of a new 30% tax rate, effective 30% tax rate for earnings on super fund balances over $3 million. There doesn't seem to be any real difference between what we're seeing in the budget papers versus what previously came out of the governments in their announcements. It just seems to be just a rehash of that same measure. The key measure there is that if your super fund balance exceeds $3 million, an additional 15% tax will be payable on any increase to your total super balance over the financial year, adjusted for any net contributions into the fund, so excluding any tax payable on the way in, and any withdrawals out of the fund during that year. So as many of you are aware, that effectively imposes tax on notional increases to super account balances, so changes in valuation of assets, including unrealised and in some scenarios unfunded gains, which can cause significant issues for some funds and members. Next slide, please, Camelia. So tax integrity and compliance, as Anthony flagged, there's been some movement on this, but that's pretty consistent with trends we've seen in recent budgets. So One thing that we've seen is that the general anti-avoidance rules in Part 4A will be expanded to cover some really specific cross-border tax avoidance schemes. The first is schemes that are designed to reduce tax in Australia by accessing a lower withholding tax rate on income that's paid to foreign tax residents. This might include, for example, treaty shopping arrangements. And so the tax practitioners that are tuning in will recall that the ATO put out a tax alert, TR 2022/2, on those arrangements last year that provides some more detail on exactly what the ATO is looking at here. Second is schemes that are designed to achieve schemes that achieve an Australian tax benefit, but are designed or have a dominant purpose to reduce the amount of foreign income tax payable. So currently the rules only capture arrangements where there's an intention to obtain an Australian tax benefit. This change is just a minor tweaking where your dominant purpose is to get that foreign tax benefit, but you get an Australian tax benefit. So these anti-avoidance rules will now pick up those arrangements. This measure will apply to income years commencing on or after 1 July 2024. So we're still a year away, but it will capture schemes that are entered into before that date and are still in place as of 1 July 2024. So this is something that really needs to be addressed now. You need to look into your arrangements now if this is something that you consider affects you or your clients. They're really designed, though, these measures to capture really specific schemes that have come to the attention of the ATO in recent years to make sure that they come within the scope of the Part 4A rule. So we don't expect that these changes will have broad application, but as we know with any changes to these anti-avoidance and specific integrity rules, the devil's really in the detail of the provisions, and we'll see if the actual changes to the law line up with the intention here. A quick one, there will be a lodgement penalty amnesty program, and that's for small businesses with an aggregated turnover of less than $10 million per annum to encourage them to re-engage with the tax system. So what this is the ATO will remit failure to lodge penalties for outstanding tax statements lodged in the period 1 June 2023 to 31 December 2023. So there's a 6-month amnesty, and that only applies to tax statements that were originally due during the period 1 December 2019 to 29 February 2022. The government will also provide additional funding to the ATO and to some extent Treasury to expand their compliance activities and programs. Now we've got some money in there for the personal income tax compliance program that's ongoing. That's going to focus on emerging areas of risk for personal tax. For example, deductions claimed in relation to short-term rental properties that individuals operate. There's quite a bit of money, $590 million almost, that's going to focus on promoting GST compliance. So the correct remission of GST collected and the correct claiming of GST input tax credits. This is a major risk area at the moment for the ATO in both fraud and non-intentional non-compliance. We're seeing a lot of activity in this area, and we're really expecting that this additional funding will ramp up the ATO compliance action substantially. The ATO is also continuing to fund compliance activities directed at private business and high wealth compliance with a heightened focus on tax debt collection. So there's going to be more funding for the ATO to engage with individuals and businesses, particularly on high value debts, so above $100,000, and age debts older than 2 years. The main taxpayer groups in their sights for their increased debt collection activities will be public and multinational groups, as they always are, with an aggregated turnover though of more than $10 million. So that is quite a low threshold, relatively speaking. And privately owned groups and individuals controlling over $5 million of net wealth. So when they say controlling, we take that to mean they're related entities, for example, trusts that they control. These announcements are no surprise. As I mentioned, targeted compliance programs have been a real growth area in the budget for a better part of a decade, and they do seem to be yielding some good results for the ATO. The focus on debt collection and recovery activities, particularly from taxpayer groups who are seen to be able to afford it, signals that the COVID-19 hangover and that soft touch approach that we saw the ATO taking in relation to debt recovery, that's truly over. The ATO is really focused on bursting that tax debt bubble. That's the final thoughts from me, so I'll hand back over to the next speaker.
Thanks, Todd. Now, if you'd like to read out more about these measures that both Todd and I mentioned about in more detail, please head to our website for our budget analysis. And also, as we're going along, if you've got any questions you'd like to ask of our speakers, please feel free to populate those in the Q&A box at the bottom of your screens. Look, now we're going to hear about or hear from our industry leaders. And first, I'd like to turn to Meg. Meg, what announcements caught your eye in the budget from an ESG perspective?
Thanks, Anthony. Well, there was a lot. Camelia, if you can pop up my slide, I've got them all on one page. You'll be pleased to know. So I think while the media focused on the cost of living and the budget speech focused a lot on that, I think it'd be fair to say that it really was an energy-focused budget, with the energy transition being spruiked as a real opportunity, Australia's biggest opportunity for growth and prosperity, and seeking to position us as a renewable energy superpower. So for the renewable energy sector, a lot of great announcements to stimulate and support the transition to clean energy technologies, with the headline number being that $40 billion to support the transition. Probably the biggest focus of the new announcements last night was the Hydrogen Head Start program, which has $2 billion towards it to support this new industry and to help it bridge the gap between the market price and the cost of production at the moment in Australia. So funding isn't expected to flow to developers for about 3 years while the program is set up and the design of the program is undertaken. But it appears that the intention is to run a competitive application process and to select 2 to 3 hydrogen projects that will be supported by the program. Another part of the program, or another aspect of it, is the $38 million announced for the Guarantee of Origin scheme, which will fund the clean energy regulator to certify and track emissions to ensure the integrity of the program. A further $5.6 million was allocated to the Federal Department of Climate Change, Energy and Water to analyse and leverage Australia's competitive strengths in all renewable energy sectors, so not just the green hydrogen. Another important focus was the National Reconstruction Fund Corporation, which will be set up to administer the $15 billion fund being established to support renewable energy and grid upgrades. The NRF will partner with the private sector to invest in priority areas, including the Powering Australia Battery Technology and Skills Program, Tasmania's Battery of the Nation projects, $1.5 billion included in that towards the renewable energy zones in Victoria and offshore wind, and $4.7 billion for transmission projects in New South Wales. Also announced ahead of the budget last week was the $1.9 million towards the new Net Zero Authority, which will be established under legislation in addition to the climate change and different to the Climate Change Authority, to help manage the transition from fossil fuels to renewable energy. And this is a particular focus of this authority will be on the provision of support for workers in the fossil fuel sectors, with a real focus on those regional towns that are heavily reliant on those sectors to help them transition to new technologies. Another aspect of that authority will be the coordination of policy across all levels of government that impact on that, so local councils, state governments and federal, to attract new industries to those regions and to assist investors to take up opportunities to invest in renewables in the regions. So that was a very important announcement and a new one last night or last week. $600 million was also announced for the Powering the Regions Fund, or from that fund, I should say, to assist emissions-intensive industries to that have obligations under the new safeguard mechanism that was legislated just recently, to assist them to improve their global competitiveness, so the ones that are trade exposed, and to encourage investment in renewable or emissions reduction technologies, I should say, to help them meet their legislated targets, which are almost 5% reduction each year until 2030. Another important announcement was the funding to support the sustainable finance agenda. So that included 8.3 million towards the new Sovereign Green Bonds program, which will be managed by the Australian Office of Financial Management. And they're set to work with super funds and other big investors to finance public projects that will assist with net zero targets. Another 1.6 million as part of that sustainable finance agenda for the development of a new sustainable finance taxonomy. So similar to that being developed in Europe, to assist industry to standardise definitions and give investors greater confidence in what they're investing in. And related to that is the further 4.3 million for ASIC to continue its focus and crack down on greenwashing practice in the financial markets sector. So in closing, probably what didn't get as much focus as I was expecting is funding for resilience and climate change adaptation projects. What was included was a further 200 million towards a disaster ready fund to support levee upgrades, seawalls and bushfire reduction projects. But I probably expected that to be a bigger focus. There was another 230 odd million for a flood warning system that's proposed. And that's adding to announcements last October that included 230 million for emergency response capability and another 15.9 million to engage with First Nations people on climate change adaptation projects. So a lot in there for the energy sector and ESG generally with the greenwashing funding as well. But probably what's lagging is that adaptation focus. Thanks, Anthony.
Terrific. Thanks, Meg. Now I might hand over to Katrina. Katrina, could you tell us about what's in store from a social and affordable housing perspective?
Yes, thanks, Anthony. So housing continues to be a focus of the budget, and there was some good announcements in this budget off the back of the very significant announcements about matters such as the Housing Australia Future Fund in the previous budget. And Camilla, if you can just push the slide on, thank you. So Anthony's already spoken about the build to rent tax concessions in his presentation. There has also been announced additional funding of 67.5 million in 2023 to boost homelessness funding to states and territories. And as part of that, a one-year extension of the National Housing and Homelessness Agreement to 30 June 2024, which is an agreement between the Commonwealth Government and the states as to the distribution and use of those funds. Another significant announcement that will be of importance to our community housing provider clients is the Commonwealth Rent Assistance increase. So CRA will be increasing by 15% over a period of 5 years, commencing from 2022-2023, with a cost to the government of 2.7 billion. So what that will do is it will increase the revenues that social housing and affordable housing generate, which will assist community housing providers that are providing that stock. If we can just move to the next slide. Also in relation to the increase of social and affordable housing, there has been an increase of the NIFIX liability cap by 2 billion to 7.5 billion to enable the increased support for social and affordable housing through loans to community housing providers. And NIFIX investment mandate has also been amended, requiring it to take reasonable steps to allocate a minimum of 1,200 homes to be delivered in each state and territory within 5 years of the Housing Australia Future Fund commencing operation. Obviously, the Housing Australia Future Fund is seeking to deliver a lot more houses than that, but that's to do with the equitable distribution of those houses across all states and territories. The government's also announced that it will redirect interest earnings on any unallocated NIFIC funds to support the delivering of housing priorities nationally. So these, if you can just move to the next slide, thanks. These measures are said to expand on the 2022-2023 October budget measures, which included very significant announcements on the Housing Accord, the Housing Australia Future Fund and the Help to Buy scheme. Now, in particular, the Housing Australia Future Fund has been a real area of focus in the industry of social and affordable housing, with the announcement that the government was to invest $10 billion in the newly created Housing Australia Future Fund, with the aim of generating 30,000 additional social and affordable homes over 5 years. This legislation is in bill stage, and the government has been doing a lot of work to try and get this legislation through. It was unfortunate to not see announcements that this legislation was approved by this particular budget. And so the main area of focus in this industry group at the moment is really following the Housing Australia Future Fund and hoping that that legislation gets passed as soon as possible so we can see those projects delivered. That's the legislation is largely supported, but there is some senators that are holding back that legislation at the moment. So that's all from me, Anthony, and happy for you to pass over to our next presenter.
Yeah, thanks for that, Katrina. Alison, can you tell us what was in the budget for the health sector?
Thanks, Anthony. Next slide, please. So generally, we welcome the government's announcements for the budget for health, aged care and disability, and some I will talk in more detail, but overall they are reforming Medicare and they're providing incentives, including in providing incentives for bulk billing to eligible persons, strengthening the health and aged care workforce, and Australia is in great need for that, increasing the role of qualified nurse practitioners, assisting with the funding of wage rises for the aged care sector, and providing scholarships for the education of the aged care workforce. Again, Australia is greatly in need of that. And improving health systems through use of technology, which is fantastic, including expanding the My Health record and introducing the My Medicare system. They're also implementing preventative measures. We've seen vaping becoming quite prevalent, including through schools, so the government's addressing that as well. Next slide, please. So in relation to healthcare, we're very excited, actually I'm very excited to see the Medicare reforms. And one of the major advancements is that they're going to provide an incentive for GPs to bulk bill more consultations for families with children under 16 years, pensioners and Commonwealth concession card holders. So that makes it easier for those people to access GP and not have out-of-pocket expenses if they're going to see their GP, so that's just wonderful. They're going to also improve some Medicare items, etc., for longer consultations. So people with more complex needs, they're going to be able to access longer consultations with their GPs, for example. They're going to implement arrangements for more integrated healthcare, so GPs working closer with nurses and allied health professionals, which is fantastic. Encouraging GPs to stay open for longer hours. I'm not sure whether they're going to be happy about that, but it's great for us. Also assisting frequent hospital users to access multidisciplinary care. They're going to increase the rebate for the standard consultation with nurse practitioners. So that's just fantastic because, you know, we have a restricted workforce. So if we can use our qualified nurse practitioners more, that's going to be fantastic. And they're implementing more support for Medicare urgent care clinics. So that's really good. And that's what I said before, they're going to have a new Medicare rebate for consultations for 60 minutes or longer, and that really helps people with chronic conditions and complex needs. They're supporting mental health and suicide prevention, which is an important part of our healthcare system. And lastly, but not least, they're going to put in $29.8 million as an initial investment to reduce fraud. So we've acted for a number of clients in relation to Medicare audits and investigations. So if you're in the healthcare industry and you bill against Medicare, expect them to be much more vigilant in terms of auditing you, and they're going to be more active in terms of reducing fraud. Next slide, please. The My Health record, most of you would already know, every Australian citizen who has access to Medicare is entitled to have their My Health record, and that provides your digital health record. You have the option to choose what should be on that. So they're going to continue to invest in that. And they're going to introduce the My Medicare system, and that will help GPs work more closely with nurse practitioners and other primary caregivers, and it will make it easier for GPs to provide telehealth consultations. I think one thing, I mean, COVID-19 was a challenge for the Australian population, but one thing that has been a revelation in my mind is that people now can, you know, instead of making an appointment to see a GP in person, they can go online and make a booking and see them via telehealth, and that has amounted to great benefits for the population, but more so for our population who are immobile. So if they've got a disability or they're in aged care or they're remote, they've been able to access GPs more easily using telehealth. And I think that's just the future for healthcare, and it's just wonderful. As I said, the Australian workforce for health and aged care is restricted. We've got a shortage. The amendments to the Aged Care Act beginning this year, residential aged care facilities have to have a registered nurse 24/7, and there's just not enough nurses in Australia to do that. So it's absolutely wonderful to see the Australian government support the scholarship program to improve the skills of nurses and midwives, and also improve the training for our medical and health workforce. Next slide, please. In relation to prevention, as I said, the government has announced they're going to reduce smoking, which is fantastic. Stamp out vaping, that will be interesting because we've had lots of clients come to us and going, and we want to sell vaping products. How's it regulated in the past? It's been really focused on nicotine. So it'll be interesting to see, you can go to most shopping centres and buy vaping equipment. So it'll be really interesting to see how they do that. But it is a problem, particularly I hear from schools. The availability of vaping products. So from a preventative health protection point of view, this is a great initiative. They've announced a new lung cancer screening program, and I'm really pleased that they've announced the Australian Centre for Disease Control. So that's really good that there'll be a national focal point for disease management to improve our ability to respond to health emergencies. And that really was missing prior to COVID-19, and I think COVID-19 really did indicate the need for that. They're going to extend public dental services for people that are in need of them. And you can see at the bottom that they're investing $259.5 million for critical health infrastructure. And that's really about, if you can see, the digital space. Next slide, please. In pharmaceuticals, this is great for me, particularly. You'll be able to buy 2 months' worth of medicine rather than having to go in for 1 month, so that'll be fantastic. And so that will save a lot of the work, the pressure on GPs as well as pharmacies. And they're increasing PBS listings for medicines to treat COVID-19 and cystic fibrosis, as well as other medications. Next slide. Anthony, have we got any questions?
No, you're good to go.
I'll keep going. Okay. In aged care, as you might have known, the Fair Work Commission made an interim decision for a 15% pay increase for affected aged care workers, and 3 awards, and I've listed them up there. Given that the aged care sector, more than 50% are losing money, running at a negative profitability, we're all wondering how that is going to be paid. So it's really wonderful that the government has put in place $11.3 billion to fund that decision. There's advancements to the National Worker Registration Scheme. There's, as people know, following the Aged Care Royal Commission, the government has announced a number of aged care reforms. I did a webinar on that yesterday, and we'll be writing an article about that soon. They'll be completely rehauling the Aged Care Act, and they have already commenced work on a number of arrangements in relation to that, including restricted practices, improving the quality standards, but then they're going to help strengthen food and nutrition reporting. And this is really interesting. This is a new one for all residential aged care providers. They should be aware they're going to introduce monthly care statements to provide information on the care provided and occurs as a significant change or events for residents. So that's going to incur additional costs for aged care providers. We know that they've implemented as part of those reforms following the Aged Care Royal Commission star ratings, a bit like TripAdvisor for aged care. So they're going to enhance that and they're going to expand the existing quality indicator program. They've announced 9,500 additional home care packages, which is wonderful. I think they should do more of that to help people stay in their homes longer. They're implementing a new aged care task force, which will help inform and develop options for how aged care funding will arise. Aged care residents will have better access to high quality continuous primary care through reforms to strengthen Medicare with new incentives for GPs to provide care to residents through the My Medicare. And that's absolutely wonderful. We have clients that, residential aged care clients, simply can't get GPs to visit residents in their homes. So if they can do that, that certainly will improve the health of our older population. And also they've provided some funding for our First Nations care in relation to aged care as well. Next slide, please. In relation to disabilities, I think this is my final slide. Most of it really is interesting. It's focused on the employment sector for disability. As most of you know, there's a Disability Royal Commission as well. And I'm sure that they will be making recommendations and that will be further government announcements following that. But you can see that they're trying to increase the capacity of supported employment, which is fantastic. They're going to invest $31.4 million to streamline and improve disability data collection, $11.7 million to establish a disability employment advocacy. And you can see some of the other announcements there. It's interesting, they've provided $3.2 million to extend the National Disability Abuse and Neglect Hotline. One thing I would really like to see is nationally in Australia, there's mandatory reporting for child abuse, but there's no mandatory reporting for elderly abuse or disabled abuse. So, I think the government really should look at that as well. So there's lots happening in the health, aged care and disability sector. And, I think if everyone can access GPs easily, if people can use technology to provide better outcomes for patients, it's a great thing. Thank you, Anthony.
Terrific. Thank you, Alison. Look, that's the end of the formal part of the today's session. We might finish off with just a couple of questions. And when Meg was talking, she mentioned about some of the things that she was hoping to see or expected to see in the budget, but didn't. I'd like to maybe ask our other speakers, and maybe we'll start from the top with you, Yarrick. And if I could ask each of our speakers to maybe limit themselves to 1 to 2 minutes, but was there anything in the budget that you expected to see or didn't see or would have liked to have seen?
Yeah, I guess from my perspective, there were a couple of things that I would have liked to see the government do a little bit more on. I think one of the key challenges from a macroeconomic perspective that the economy is facing, has been facing for probably the last decade and will face for the next decade, is lifting productivity growth. This is incredibly important for economic well-being going forward into the future, and productivity growth has been quite weak over the past decade or so. Now, there were some things that the government's, I guess, has done in the previous budget and also in this one, for example, with renewable energy and the green transition, which should assist. But I think they would have liked to see more to really help lift productivity more directly, more on the competition side of things, for example, to help encourage more competition among businesses, more dynamism among businesses, and help to address some of the oligopolies that exist across the Australian economy as well to help boost productivity in the long run. I think some of the other areas that would have liked to see more being done on is something that economists have been talking about for a very long time and will continue to do so, which is wholesale tax reform, to really look to shift the tax system away from relying on less efficient revenue sources, particularly income, such as personal income and corporate income, and then shifting to more efficient sources of revenue, such as consumption taxes, wealth taxes, land taxes, and also getting more out of our mineral resources as well in Australia. So it would have been good to see that wholesale reform, but of course that's something that's quite challenging from a political perspective. And probably the final one I'll touch on is just what I mentioned during my session as well, where the government is forecasting dwelling investment to actually go backwards for 3 years, while it's also forecasting migration to run at record levels pretty much for that same period. And while they've done a few things on housing, we were thinking that was really an area where they probably needed to do quite a bit more, given the really large imbalance that's going to continue to occur in the economy between demand and supply of housing, and the fact that those supply measures, are sort of more long-term and will take quite a long time to be implemented. And of course, the rent assistance measure is positive for those people on rent assistance, but given how tight the rental market is, it's likely to just flow straight through into higher rental prices and not necessarily leave those people as much better off in net terms. So that's really another area that we would like to see quite a bit more done on from the government.
Terrific. Thanks, Yarrick. Certainly those comments about tax reform are music to Todd and my ears. But Todd, was there anything else that you would have liked to have seen in the budget?
I think Yarrick hit the nail on the head when he spoke about broad-based tax reform. We've been asking for it for ages. The whole industry is really screaming out for it. It was good to see, try to stay apolitical on these webinars, but it was good to see that there was a summit recently in Canberra, which brought together a lot of industry members and some politicians to discuss the need for broad-based tax reform and what that would look like. Didn't expect to see it in the budget. I think that the days of surprise structural tax reforms in a budget without any real consultation or flagging beforehand are probably done. We expect that will happen outside of the budget cycle. But on a more specific note, on the private wealth side, it would be great to see some more reform, particularly in relation to Division 7A and the taxation of trusts. They are two areas that are really complicated at the moment and are causing real issues, and it would be great to see some movement on tax reform in those areas.
Great, thank you, Todd. And Katrina, anything missing from your perspective?
Look, the main thing I was hoping to see that didn't come through was really further development of the Housing Australia Future Fund. This fund is really critical for the creation of new stock, especially in the area of social and affordable housing, and is projected to create an additional 30,000 homes. The reason why the legislation is not being passed is because what the Greens are saying is that not enough homes will be coming out of that fund. And whilst more homes than that would be great, it is a very important sort of step in the process of addressing the housing problem. And if the legislation continues to be held up through, politics and things like that, it would very much defer the construction timelines and the project timelines for these projects. So we're just, very, very keen to see that legislation pass through, and then for the government to take action on that in terms of rolling out those projects.
Okay, great, thank you. And Alison, any final comments?
What was missing from my point of view was we normally see quite a piece on health and medical research, and we really didn't see that in this current budget. So it'd be nice to see more investment in that, and also further extension of maybe the R&D tax incentives. Would be great to see Australia thrive as a primary country that leads health and medical research. We certainly have the scientists. We tend to lose them once we get to commercialisation overseas. So it'd be great to see some funding helping Australian businesses thrive in that area.
Terrific. Well, that's been great. Thank you all for your thoughts on what was missing from today's or last night's budget. We're pretty much at the conclusion of our session today. So I would like to thank all of our speakers for joining us. Yarrick, Todd, Meg, Katrina and Alison. And a big thank you to all of you for watching today. A reminder to keep an eye out for our budget analysis article that's going to be released later today. And please reach out to the team if you have any questions about anything that was discussed at today's webinar. Thank you all for joining and enjoy the rest of your days.